proof of corporate governance is in the earnings. Shifting focus from accounting to accountability. Entity profitability and growth index of M&M and Reliance. We are here at the last earnings, the most important for any company. The issue is proof of the corporate governance is in the earnings. That's how the companies work for. In the CREAM report, we have talked about corporate governance, risk management, earnings, accounting quality and management quality. We have talked about the board of directors, the committees, independent directors, vigil mechanism, SEBI's LODR 17 to 27, risk management, accounting quality, and risk management. We have also seen the water security, carbon emissions, product stewardship, health and safety, and sustainable supply chain. These are the things which go into 2030 or 2047 Viksit Bharat. These are all futuristic. When you look at these standards which we have put, there are about 308 process blocks, totaling about 7,700 standards to be reached. These are the targets. 308 process blocks may have about 1,000 subsystems. It's not that 308 is only a process block. There are more number of such process blocks comes to create each and every one of these final 308. So be prepared for that. When we look at that, we are looking at the now we have come to look at the earnings part of it. The earnings, if you look at this net sales, when you talk of 2047, 2030, we are talking of the futuristic one. We have a CAGR. The CAGR or CARR. CAGR for net sales, employee benefits, in terms of how much the sales that they are able to provide with, or net sales and is the APP, effort per person, to create productivity for the purpose from the employee. They can get the employee benefits. What is important is the effort that they put in for each and every operation of the company. They are the most important. And the profits. We are looking at the profits. We are looking at the growth. Sustainability of growth is the very important one. And also the reduction rate, CARR, consumption, finance costs, other expenses, etc. So we're looking at one area in trying to get the P&L in a certain shape, and which has a significant effect on trade payables, net fixed assets, return on investment, inventories, trade receivables, non-current liabilities, current ratio, debt equity ratio. All these we analyze for what? For the purpose of getting the critical corporate density. This is a corporate critical density is the most important thing, so that we set the standards. When we say 7,700 points are to be reached, the target to be reached for 308 process blocks, we are looking at the critical density. Unless each and every one of that process block shines like a star forever in terms of producing the optimum result, then your corporate critical density is affected. And this is what we are going to do in this particular episode, for the purpose of finding out the earnings part of it. As Steve Jobs said, we can't predict how things will work out in the future. We can only understand how things fit together when we look back on our past. So we are looking back in our past in these areas, CAGR and CARR. If you put that certain corporate SYS governance standard of what would have been, or in terms of what you would like the CAGR to be 20% or 15% or 5%, and if you apply that particular standard for what had happened in the last 4 years, then you are able to find out where actually you have done your work or APP in for your own company. So that is what we are going to do, and find out what the things are in M&M. And also I have brought Reliance. Largely these companies have the good standards in terms of bringing out the corporate governance. Corporate governance standards for these companies are not bad. It's very good, actually, extremely good, and for the purpose of getting the productivity out of it. They are very great people, Mukesh Ambani or Anand Mahindra. So take an example of these companies and find out where they were in the last 4 years and project that. If you have to have for 2030 target or 2047 target, which you are going to come into, whether they will be in a position to participate in the 2047 Viksit Bharat of, say, 20 trillion or 25 trillion, whatever we are talking about. And that's what we are going to do. Take a look. We are now at the action process rating system, when we are going to look deeply into what the companies have done in the last 4 years. Action process is crucial for organizational goal congruence, focusing on increasing revenue, containing costs, and managing investments. I advocate for publishing future strategic plan 2030 in annual reports rather than just reporting past performance. Number three, banks and companies should set long-term growth targets and work backwards to establish a daily growth rates for reaching 2030 targets as on today by CDGR, that is the daily growth rate, and CDRR, daily reduction rate. I talked about the concept of over 7 factor based on physics principles, a critical conversion factor of .over 7 for optimal performance in business processes. This is why we have created the SOS governance standards for critical density. Finally, here we look into earnings of Mahindra and Mahindra, and as well as Reliance I have brought in, of the last 4 years, how they have done and where they have to set their eyes for strategy plan 2030. Possibly we can find out who can reach the targets of Viksit Bharat 2047. How well, how easy, is very tough. So let us take a look. Here are the 5 key points summarizing my speech from the next about 2 pages on entirety rating of M&M, Mahindra and Mahindra, and Reliance. Number 1. The transcript discusses entirety ratings for earnings of Mahindra and Mahindra and Reliance using a scale of 0 to 5 for different aspects of their P&L and balance sheets. Number 2. A 15% CAGR is used as a standard benchmark for various financial metrics, with ratings assigned based on how companies perform against this benchmark. Number 3. The analysis aims to provide a holistic view of company performance, considering factors like debt-equity ratio, inventories, net sales, and employee productivity. Number 4. The concept of corporate critical density is introduced, which involves converting matter, that is financial data, into energy, employee efforts, to improve company performance. Number 5. The importance of sustainability in profits and growth is emphasized, with the noting that 296 out of 308 process blocks relate to factors like code of conduct, the board performance, and risk management, which contribute to long-term success. In this page, you are looking at the entirety rating, E for earnings, M&M, as well as E for earnings, Reliance, RAL. In the case of M&M, 2021, 22, 23, 24, the same thing as Reliance. In the last 4 years we do. And P&L gets a rating of 3, 3, 1. That is in 22, 23, 24. 3 is formation, 1 is conceptual. In the balance sheet, they get 1, 2, 2. 1 is conceptual, 2 is communication. So net rating is 2 to 1, which is equivalent to communication, communication, conceptual. In an organization, we are accustomed to analyze the variance analysis between the consumption, particularly, and what the input output, what the standard for the buying, and as well as for input to the production, and as well as in the marketing. That variance analysis adverse to a great extent is on a specific area. On supply chain management, we do that. But in this case, is overall conceptually analyzed on a holistic view of the company as a whole. We have put the corporate critical density in terms of debt equity ratio. We're talking about the total debts and as well as the equity. We are talking about a holistic view of the company. And we look at the inventories or we look at the net sales. We are looking at the overall concept of how it has functioned. When we do that standard, each has got a standard. In this case, we do not know what ought to be in terms of it had not been worked out in the last 4 years, it had not been worked out. So we put a 15% as what ought to be. When you look at the 15% as CAGR, we said ought to be for net sales or for profits or for the employee benefits or that sort of thing. They ought to get at least about 15% productivity. That is what they have to get in terms of your net revenue. So when you look at that, 15%, the 4 core areas which we distribute for action process is 1/4 of each. That's about 3.75%, 7.5, 11.25, and 15%. One before that is less than 0, one above that is greater than 15. So when you do that, we have, sync with standards. Standards are 6, which is also 0, 1, 2, 3, 4, 5. And the same ratings are made available for the action process. So it's easy. Subsequently, when you P&L and balance sheet, when you do that, you are able to add it. 1 plus 2 equal to 3. Divide by 2, you get 1. So it is conceptual. It is not 1.5, that sort of thing. We take only the integer. So when you look at that 3% we use as possibility of the consumption part of it, which is very difficult for any manufacturing company. So we have applied certain percentage on 15%. We applied certain percentage for only for one. I applied for 3%. We are able to do it for individual cases, and ultimately we are able to get the total for each P&L and as well as for the balance sheet, and arrive at what M&M has got the net entity rating, which is 2 to 1. 2 to 1 means they have actual, which had been in terms of compared to the standards, they have got 2 to 1 means it is communication, and conceptual. The conceptual is that there are very many areas, like when you say 1 in the balance sheet together in the first year, what are the impact of it? Where does it go? Why that debt equity ratio may not be there, or the borrowings had been in a manner which is not applicable, non-current liabilities are there, or current assets, current liabilities. So many things are there. When you look at that in comparison to the standard, as we do for the variance analysis for your supply chain management, buying and as well as the consumption part of it, the same we apply on a holistic view for in totality. When you do that, there is EPP, effort per person, for each. That is, when you say balance sheet 1 of say 6 areas that we have measured, it looks into EPP, every effort per person of any number of people. If there are in a factory about 5,000 people, each and everybody has to look into that, what their area of contribution, which is available. To arrive at that 1 to 2 or 2 to 1 in M&M rating, we arrive at the return on intangible, effort per person, what is the total number of employees who are going to contribute for this era. The next stage is to take it up further. This is the corrective action. You're only in 2. You've got to get 5. To get 5 as an integrity rating, you've got to recalibrate the corporate critical density, which I have indicated as the .007 factor. That over 7 factor is the contribution, the conversion of matter into energy. The matter is what we have in this P&L and balance sheet. The energy is what the employees have. So the energy has to be put in terms of converting the matter into energy. When you do that, we have to get the 5. That is the target. When you have a 2030 CAGR of to get the 555 in 2030, CAGR 15%, or CAGR has to make it to 50% in this thing. We got to create that opportunity to get CDGR at 15% as on today. Then only we will be able to do that. Conceptual means we are back to square one. That is the decision making process. It rings a bell. Hi, we've got to look at why and where we failed to reach the target. It could be consumption, it could be sales, it could be various other factors in the growth rate. Next stage is communication. After conceptual is a communication. Discuss with the core team of think tank for the company each and every process area that had failed to reach the target. Next to it is a formation of a right team. When we say we failed to reach the target, each task and each person by APP is evaluated. Recast the team and form a fresh one for every process area. As Confucius said, when it appears that the goals cannot be reached, don't adjust the goals, adjust the action steps. Then formulate new strategy. The new strategy has to be brought in, which is a substance of quality. The intention is index of inactivity for each and every task by each and every person by APP, effort per person. What is now in 0 or 2, fresh strategy paper be ready to reach the set targets. We are looking at the past 4 years. It is a trial run for strategy plan 2030. Let us look at Reliance now. Similarly, for Reliance, it has a 310 for P&L account and 221 for balance sheet, arriving at the entirety rating of 210. That is, if you look at the optimum level, it is 5. 3 in the P&L when you see it. What you have obtained, that it is active for the 2022, but 1 and 0 for 23 and 24. So inactive is 2 for 22, inactive is 4 for 23, and inactive is 5, meaning 0 effort. Is very important. What it means is that you have a set 15% as CAGR as standards for sales and profits, and 3% as CRR, that is reduction rate for consumption. 310 is the result of deviation from the standards. Otherwise, it should have been 5. This enables to prepare an index of inactivity by each process area with corresponding resource area identifiable by each person for each task. If you look at 3, you obtain a P&L related process areas of 3. But in 2023, it went down to 1, whereas M&M continued with 3 and 3. In 2024, M&M P&L rating went down from 3 to 1, whereas Reliance 1 to 0. Standards being the same for both the companies. What is the standard? 15% CAGR or 3% reduction in consumption, that sort of a thing. But if you want to have the sustainability of profits, 3 must continue to 3, 4 and 5, not 310. So that P&L, if you look at the profits aspect of it, there is no continuity of profits. So the sustainability of profits is in question. Whereas you look at the balance sheet, it is growth. For Reliance, 2 and 2 and 1. And for M&M, it is 1, 2 and 2. for 2022, 23, and 24 respectively. Poor ratings for both the companies. I mean, compared with only 15% CAGR or 3% CARR in some cases, and 15% CARR in some cases also. I will give the explanatory note later. Sustainability of profits contribute to the sustainability of growth. It's very important. That is the answer. The question was, what is the sustainability of value system? The value system is the one which is able to provide the sustainability of profits, and that is the one which gives in turn the sustainability of growth. Make very clear about it. We have been mentioning about 308 process blocks, out of which only 12 are P&L and balance sheet. 296 belong to the various factors like code of conduct or how the board of directors work, how the vigil mechanism works, how the LODR 17 to 27 of SEBI works, and risk management, internal control set, code of business principles works, accounting policies measured. So we have 296 process blocks which are standards for value system incorporated in any company. And how that would bring about a change from 3 to 4 to 5, and why sustainability of value system is the answer. So that is where we have to look into. Now, to reset standards for Strategy Plan 2030 from the current entirety rating of M&M 2 and 2 and 1, and for Reliance 2 and 1 and 0 in 22, 23 and 24 respectively. Here are the 5 key points summarizing my speech, which I'm giving the next about a couple of pages. On segment revenue, M&M and Reliance. Take a look. Number 1, the transcript analyzes segment revenue growth for M&M and Reliance using CAGR and a rating system based on 15% growth as a standard benchmark. Number 2, it suggests that larger companies should aim for higher CAGR targets, 20 to 40%, to reach India's economic goals by 2030 and 2047. Number 3, I present a projection for India's GDP in 2030, aiming for $5 trillion with specific allocations for agriculture, 1 trillion, industry, 1.75 trillion, and services, 2.25 trillion sectors. The importance of agriculture industry sectors is emphasized with a focus on increasing their shares in the economy while potentially reducing the service sector's dominance. Number 5, for M&M and Reliance, the transcript analyzes their segment-wise performance and stresses the need for corporate governance and strategic planning for each business segment to achieve consistent growth by 2030. In this page, I am giving the segment revenue from operations for M&M as well as for Reliance RIL in 2021, 2022, 2023 and 2024. I arrived at the per day revenue, which is growing from 209 crores per day to 392 crores for M&M and 1556 crores to 2805 crores for Reliance. For M&M, when the percentage of increase is worked out on the basis of CAGR, the incremental revenue is 21.80%, 37.92%, and 11.67%. So if you refer to the 15% table, you get a rating of 5, 5, and 4 respectively. The rating of 4 is formulation. Whereas in the case of RIL, the same CAGR 15% is being used. It is 42.75% in 22, 22.89% in 23, and 2.77% in 24. And there is a big dip, Reliance is concerned. If you refer the same table for 15%, you get a rating of 5, 5, and 1. As far as Reliance is concerned, and 5, 5, 4 for M&M. 5 means a task is accomplished at 15% CAGR standard set. This is very important when we do the analytics. 5 is the optimum level. 15% CAGR is set as standard. You can put only a 3% CAGR, you'll get every year 5. So any growing company, you're looking at the growth pattern. The 5 once you reach, you have to increase your CAGR. And in the case of M&M and RIL, from 15% to a higher level. M&M has scored an optimum level of 37.92% and Reliance 42.75% and a minimum of 11.67% and 2.77% respectively. The minimum is obtained in 2024. So what is the benchmark CAGR you choose for 2030 is critical. As far as this case study is concerned that we are presenting here, M&M and Reliance for the past 4 years from 2021, when you look at the CAGR for 2030, instead of 15% CAGR as standard, you have to recalibrate your higher CAGR, maybe 20% or 30% or 40% as you feel. Then only you can reach out to Viksit Bharat 2047. This means bigger companies have to set higher standards and work harder. I am giving in the next 2 pages my note on sector-wise GDP India 2030 that I prepared for one of my podcast episodes. Industry sector is about 35%, although CAGR appears different within each of the industry sectors. What is important to note is 1. Maximize CAGR in manufacturing sector by companies like M&M and Reliance that we have taken as a case study, a minimum of 15% CAGR 2030 as standard. Considering the difficulties in consumption percentage, the reason why I put CARR reduction rate is just 3%. Bigger companies cannot falter in the segment revenue projects. For the sake of keeping industrial development, government expenditure on infrastructural development is huge, very huge. Therefore, industry has to necessarily keep a standard of 15% CAGR for GDP 2030 and work towards applying as a standard for all companies. Better company profits would lead to cut in corporate tax from the government and not the other way. Sustainability of profits assurance should come from the companies. Therefore, PSUs and PSBs have done well showing the way in the last about 10 years. Let not private sector keep on mumbling that corporate tax but focus on efficiency. Segment revenue must go up, never come down. Here I am presenting the figures, GWA in 22-23, rupees and crores mainly, constant prices and current prices. I've taken to the current prices when we are going to look at 2030, extending to 2030. So the current prices, the share being agriculture sector, major industry sector and service sector, converted into billions since we are talking about the $5 trillion. We shall convert the base price also in terms of dollars. So the number of billions of dollars which is being given in this particular table, totaling $2.981 trillion as on today's, as on not today, it's 24 almost coming to end. 23 yen was 2.98. In 80 years, the 3031, we are going to reach to $5 trillion. The $549 billion on today agriculture sector, I have earmarked out of $5 trillion, $1 trillion for agriculture sector. Number 2, I have come to industry sector, which is currently at $842 billion, is almost double, in fact slightly more than double. I'll explain what it is. To 1754 billion is 1.754. And the services sector is 1589 to 2.245 trillion dollar. Now, it is an adjustment figure as far as service sector is concerned, because I have given the specific figure for agriculture, specific figure for industry sector, and then service sector is the balance. I am not putting it that 5 trillion in 2031 will become 6 trillion, keeping the percentage of 53.33. No, I am bringing down the service sector to 44.91 by balancing the figures from 5 trillion. So if you look at the agriculture sector, it is going up from 18.42% to something very different to 20%, slightly more. The reason being that gives a projection of $1 trillion in 2030-31. China and India were going neck and neck every year until 1993. 93 onwards, Indian agriculture became flat, whereas Chinese agriculture sector had gone up to 1 trillion today. So, which is feasible with India projecting that figure of 1 trillion? There are two reasons. One is very well organized FPOs, the farmer producing organization. It's like a corporate house. It is beautifully done. Any number of FPOs have been created in India with a regulated framework. It's a beautiful concept which no other country possibly has. Is just like a corporate, joint stock company, and that each one FPO may have about 40,000 farmers, 50,000 farmers, or 100,000 farmers in each sector, all over, spread all over India. So agriculture is is a very good economy, very paying economy for the farmers, because I stay now in a village. I know the farmers there are very, very happy about the because there are no income tax and all that. So it's a beautiful sector, but what is needed is to go up in the production side or produce of $1,000 billion, $1 trillion, for which, for example, in the case of COVID-19, 80 crores people had been fed free ration in the whole of COVID time, and that is the only reason that India did not falter. Had it not been the case, India would have been wiped out completely. And that is a sector which ought to be given the first priority, and which is going to be a paying one, which is the most important thing in a country like India. In fact, Argentina also was there. It was in a bad shape economy wise, it was a bad shape. But the agriculture gave them the support to survive. So agriculture is the most important, and agriculture is a major problem all over the world. So India must give the priority for agriculture out of the 5 trillion in 2030-31 to 1 trillion as far as agriculture is concerned. So it is feasible. I'm giving that how it is feasible. In fact, I've given a complete write-up on that. So I'm giving the yield and other things and all that, where we have to go, what is the total produce. Everything I have given a separate episode, podcast episode, which I will give the connection which I am giving here. Number two, industry sector. I'll come to the industry sector. One thing which I feel about it is that it is going to be the most important industry sector. Industry sector is going to be the most important thing, which I'm taking up to 28.25% to 35.09%. One of the things which I put is that mining and quarrying, which is currently 2.36%, and I expect that to become 4.22%. That is $70.31 billion to $210.93 billion. I'm giving critical metals and all that in the next page, and why it is very important, mining and quarrying, at this point of time, how it is going to support the industry sector is going to be particularly the mining and quarrying in the current scenario. So I put that $210 billion, and the manufacturing to doubled, electricity, gas and water doubled, construction doubled. So the total is $1.754.35 trillion as far as out of the 5,000, which comes to about 30% of the 5 trillion. This is very important because manufacturing part of it is going to be very critical with AI is coming, with various critical metals are pushing out. And I will give the explanation to the next stage, service sector, where it will come to the industry sector. This is service sector, it is reduced because as I said is a balancing 53.33 to 44.91%. In this, if you trade, hotels, transport, communication and services related to this is again going up, is about 15% of the total. And financial real estate is also going up 18%. Public administration are, is only about 11%. The total is about public administration, defense and other things. The reduction of from reduction in the sense of percentage of service sector 53 to 44%, it is technically feasible. The financial real estate and professional services will remain, but AI coming in, there will be a lot of reduction in terms of the service sector, both in professional this thing would mostly take care by the AI. So there will definitely be the need for expanding at the fast rate as we have been doing in the IT sector may not come through, which would be instead of having one too many people in that sector, a lesser number of people will be able to do that one. Number two, public administration. It is a thing which has to be reduced. For example, I'll give an example of what Kerala government has been doing, which the governor of Kerala had been objecting also. They have their own commie friends, the ministers and this thing, taking PAs, assistants as a personal assistant, and they stay there for about 2 years. If the law is there in Kerala government, is in 2 years if they stay, they are eligible for a pension. So the pensioners which have been coming through by hook or crook is amazing. And the public administration itself is quite amazing. For example, the economics department, economic statistical department, it is amazingly in numbers. We collect this 22, 23 in current prices and constant prices, 21 this again I have given that Indian statistical information system, ecosystem, what I call. The number of the way in which the transformation must take place in the statistical department and the public administration. I'm just looking at the statistical department as one of those who could be reduced very heavily, and so is the case with a lot of government servants in central and state governments. This public administration, cost of public administration, as they have been talking about in the states at the moment, like Ramaswamy has been telling, nearly about the EU was talking about 70% reduction. So if the public administration we are able to reduce it, then the number service sector as such will get reduced. That is their portion of the total 5 trillion will get reduced. That's one. Number two, if we come to the defense, a lot of naturally nobody is going to ask for the reduction in the defense expenditure. But what is happening from Prime Minister Modi's initiative is to bring in the private sector, whether it's ISRO or it is manufacture of various like Tejas lanes. We have a lot of private sector induction into the defense requirement. So these things will go into increase the industry sector. This is what I would like to tell. How we are going to approach that is what my main aim of this particular episode is to say beware of the Ides of March. Being beware of the Ides of March meaning we have been doing something in the past. How to reach the 5 trillion in 2030, not by the same means as we have been doing before, because industrial sector and agriculture sector is becoming more prominent. That I will explain in my next one. Coming back to segment-wise revenue of M&M and Reliance, let us take a look at M&M. Automotive business segment has done very well. getting 5, 5, and 5 in the 3 years under scrutiny, hitting a peak of 66.28%. Financial services segment is also stabilizing, but not farm equipment and others. We are analyzing M&M and Reliance on corporate governance. For each business segment, different people manage. When we look at a strategy plan 2030, we are looking at corporate governance aspects of managing each segment. How they are taking a 0 to 5 by 2030. Now, initiatives are on the anvil, and by 2030, different segment gets added, such as hybrid vehicles, biofuel vehicles, electrical passenger vehicle, hydrogen combustion engine vehicle, besides looking into the risk areas such as water security, carbon emissions, health and safety, and sustainable supply chain. Strategy Plan 2030 for companies must take into consideration these factors and work out the strategy for each segment. How to make from the state of insentience in some cases to 5 by 2030, task accomplished, consistent through the years, setting a standard 15% or higher. Now, Reliance RAL. When we look at Reliance by segments, oil and gas and retail are consistent but not oil to chemicals, which holds about 60% of the business segments. It failed in 2024, but a huge failure. This has resulted in averaging in a rating of 1. Rating of 1 means it is conceptual. In corporate governance, the decision-making process is analyzed. Conceptual means back to the creative process, the state of quiescence, to create a substance of quality for Strategy Plan 2030. In the words of Dhirubhai Ambani, it is commitment deeper and efforts greater. Next, I shall look into the direct cost for each segment, which is going to play a very major role. We shall take note of it next. This is a summary of my presentation from the next about 5 pages on segment direct costs. M&M and Reliance RIL are being analyzed. The transcript discusses segment direct costs and corporate governance, contrasting accounting, that is, which is quantitative and transactional, with corporate governance, qualitative and non-transactional. It emphasizes the importance of setting targets for 2030 and beyond, working out compound daily growth rate (CDGR) and compound daily reduction rate (CDRR) for each process block. I analyze number 3 segment direct costs for Mahindra and Mahindra, M&M, and Reliance Industries, applying a 3% CARR standard and discussing the challenges of reducing variable costs versus fixed costs. Number 4, corporate governance practices are discussed, including the implementation of the COSO framework, quarterly reviews, and independent audits. Number 5, finally, the concept of fiscal and ethical co-responsibility framework, FEC report, introduced as a governance standard that involves a team-based assessment of processes and can be extended to entire companies or even GDP calculations. Segment direct costs. What gets measured gets managed. I'll give some introduction on that. Accounting is measured data. Corporate governance is how it is managed. Knowledge base of accountability data. In accounting, we tally the trial balance of debits and credits. In corporate governance, we prepare a matrix of matter, which is process areas, energy, human energy, the resource areas. In accounting, we limit with only quantitative data, whereas in corporate governance, we measure qualitative data. Accounting is object-oriented, transactional, and quantitative, and object governance is used. In corporate governance, we look into the accountability of individuals, which is subject-oriented, non-transactional, and qualitative. and subject governance is used. Extended to the society, self-governance is used. I will look into this M&M, which we have 2 pages of detail 2021, 22, 23 and 24. The segment revenue minus the result is arrived at as the direct cost. It does not include unallocable costs or revenue. Per day direct cost is worked out for corporate governance, which is a dynamic function. Ex post facto figures are taken into account from the published annual reports, but all are ex post facto figures. But we are looking into Strategy Plan 2030, arriving at the CAGR or CARR as the case may be for each and every process block. Then for corporate governance, we shall work out a CDGR or CDRR on a daily basis. We have seen in CREAM report on risk management, we have set targets such as EP100, that is double energy productivity by 2030, reduce carbon intensity by 47% by financial year 2033 and 34, carbon neutral by 2040, etc. Companies have to set targets for 2030 and beyond and work out the CDGR and CARR for each process block. It's like playing an ODI, targets known and daily run rate is published online, and that is corporate governance. Segment direct costs for year 2022, 23 and 24 I shall explain. Segment direct costs for the year 2022, 23 and 24 is as follows. 21 is also there, but it's a blank in the sense it is a comparative for what it does in 22. Automotive. A standard of 3% is applied for the direct cost of each segment as a percentage of related segment revenue as to the CARR reduction rate. The range for 3%, please refer to the table given upfront. The automotive 2021 was 101.22%, that is on direct cost as a percentage of net revenue of that particular segment. And for 2022, 96.99%. 23, it was 96.73%. And in 24, 92.05%. Getting a rating of 5, 1 and 5. 1 in 2023 because it was just a marginal reduction of 0.27. Could have been 0. However, the overall consumption percentage to net revenue, all inclusive, works out to 51%, 56.86%, 60.38% and 59.19%. That is from 2021 to 2024 respectively. That is the overall consumption all-inclusive as a percentage to net revenue. Consumption figures relate to suppliers and 3% CARR is justifiable. I will work it out separately, the same individually. Here, the direct cost contains quite a bit of other things. Consumption is a variable cost for companies, but has no control over the supplier's management of affairs. What is to be noted in this respect from M&M is the extensive code of conduct applied to suppliers. Of the 24 process areas, which is very good, in the long run will sync with M&M's code of conduct and surely establish stability in the supply chain management. The 24 process areas applied to the suppliers shall not necessarily ensure lesser cost of consumption for M&M unless a different standard is applied to both M&M as well as the suppliers at 15% CARR for their fixed costs. In this segment, direct costs we have applied 3% CARR. It is okay for 60% of the direct costs, but for the balance 40%, the direct cost, which is a fixed cost, CARR of 15% needs to be applied. I hope I am clear about for both M&M and their suppliers, because the fixed cost alone for any company, the control can be exercised and not on the supplier side management. Since the code of conduct for the supplier are written well, M&M shall add one more, which is CARR of 15% for their fixed costs. The efficiency, that is 24 they have, add one more 25. That is their CARR of their fixed cost suppliers, efficiency of the entire supply chain management. Rest with the CARR of 15% for their fixed costs. You can't reduce your variable costs, reduce your fixed costs. That's the only way. Then only there is a chance of reducing your consumption, CARR by 3%. That is, suppliers also go through the standard of 15% of their fixed costs. Then you get benefited. It's purely selfish, but you have to do that. Otherwise, pretty difficult. Farm equipment, if you look into it, in 3 years, CARR gets a rating of 0, 5 and 0 in 22 to 24. Financial services, 5, 5 and 0. Whereas industrial businesses and consumer services also get 5, 5, 0. The skill sets of each of the segments is different for different people who run their operations. Getting a 0 despite a CARR of 3% needs further probe within the organization. You can start with a 0 and end up with a 5, but not the other way around, as we see here in these 3 areas. We have seen under internal controls, M&M is deploying COSO framework. Unit heads are responsible for implementing the procedures of COSO to confirm the effectiveness of the financial controls in that unit and correct any instances of weaknesses identified. In addition, effectiveness of operational and non-financial controls is also reviewed by the unit heads if it is not otherwise reviewed. This is achieved by several means by a CARR standard that needs to be applied and ratings taken for each person. In the decision-making process, it is self-governance area for M&M. Now we are looking at Reliance, RIL, segment direct costs. 4 years, 2021, 22, 23 and 24. Now how it has been in terms of percentage of net revenue, per day direct cost is being worked out, and how it has transformed from 1 year to the other. That is the very purpose of corporate governance we apply. And with 4 major areas of segments, oil to chemicals, number 1, tops the list. Number 2 is retail. Then oil and gas picking up very fast. Digital services and others, 5 in total. And if you look at the main table, it shows the rating, that is CARR of 3%. 3% is applied informally for consumption actually. But here the direct cost is being applied because consumption is normally in every company is very high, the percentage of in terms of net revenue. So it is very difficult also to reduce. You can't apply 15% or 10% CARR. That's a reduction rate. And if you are able to get the 3% reduction rate, any company should be very, very happy about it. So we apply as a standard CARR reduction rate of 3%. Since direct cost includes maximum but nearly 60% is a consumption part of it, the balance 40% we can apply to say 10% or 12% or 15% we normally do. But here for the purpose of analytics, we are doing only the 3%. So the direct cost includes not only consumption, various other like employee benefits and this and other things, excepting interest and some other things like tax and all that. So it's a very significant factor of analytics, how they have shined well or not shined well at 3% CARR as a standard in the last 4 years. So it has come to 102 finally. Oil to chemicals is 0, 1, 1. Oil and gas 5, 5 and 0. Retail 1, 1, 1. Digital services 4, 0, 1. Others 0, 0, 1. To make a finally total 102. Corporate governance, as I say it, is a capability model that a potter and a nuclear scientist are at par. Each accomplishes the job one undertakes. In the case of Reliance, rating of 0 and 1 are aplenty. I have said in this report that there must be a minimum CAGR of 15% as standard set for growth plan 2030. I'll quote from Reliance Annual Report 2024 on corporate governance practices. RIL endeavors to continuously improve and adopt the best corporate governance codes and practices. Some of the implemented global governance norms and best practices include the following. Number one, quarterly review by the Stakeholders Relationship Committee. Number two, Board of Committees for oversight on matters relating to risk, corporate social responsibility, business responsibility, and sustainability reporting, environmental, social, and governance, etc. Number three, executive committees of senior management for continuous review of operational and financial risk mitigation measures and governance practices. Number four, independent internal audit function providing risk-based assurance across all material areas of group risk and compliance exposure. Number five, quarterly secretarial compliance certification from an independent company secretary in whole-time practice. Number six, assurance by an independent firm of chartered accountants on the functions of registrars and transfer agent. Finally, number seven, independent review of related party transaction where one of the big four accounting firms, independent accounting firms, for arm's length consideration and comparison with the benchmarks available for similar type of transactions. This is all that. Proof of corporate governance is in the earnings. Rather, sustainability of value system, sustainability of profits, and sustainability of growth at an optimum level of 5 must be seen with corporate governance standards. Corporate critical density means it is a hole-in-one for every task handled by each person. Infosys founder recently said, Mr. Narayana Murthy, has backed Donald Trump's decision to appoint Tesla's Elon Musk and Indian American businessman Vivek Ramaswamy to lead a commission focused on streamlining government operations. Reducing government, reducing leniency of action, reducing fat, reducing inefficiency, they are good, whether it is America or India. That's what Mr. Murthy said. Highlighting his belief in cutting inefficiencies across borders. We have to extend the same for the private sector. Quarterly review, board committees, executive committees, independent internal audit, quarterly secretarial compliance, independent review by big four firms have all added to your fixed cost. Continuous review of operational and financial risk mitigation measures and governance practices are critical to maintain 5 in every process block consistently. FAC report is needed for every process block. Take a look. FAC reports Fiscal and Ethical Co-Responsibility Framework provides with the subject-object self-SOS governance standards, how they are collated and brought into a governance standard. This is very significant in terms of understanding that no single task is being entrusted to a single person. Then the governance is not possible. It has to be seen together as a team, as we have indicated here, of 5 members in this particular team. One single team is good enough for the FAC report to be created. And if you extend it to the whole company, you have any number of sectors individually collated, individually measured, each team how they have done, matter energy part of it being put through. And the company can be brought into the FEC report. No problem on that. And in addition, if you really look at it, extend it as what the universe does. After all, universe has got more number of object than what a single company has. It can be extended to the entire GDP working part of it. There's a beauty of this particular report based on the corporate atomic structure with a return on intangible on how the energy force works within a company, within a particular team of each member, and how the matter is being shifted from one space to the other. It's as simple as that. Let me give you the summary of what I have spoken for this particular chapter, profitability and growth index, in the next page. Number one, the transcript discusses profitability and growth indices for two companies, M&M and Reliance, and how these two indices combine to form an entity rating. Number two, it emphasizes the importance of employee productivity, suggesting that net sales should be 6 to 7 times higher than employee costs for good return on intangible. Number three, it proposes a strategy of dividing large workforces into small 5-member teams with one member focused on ethical responsibility to track performance and improve accountability. Number four, there is a focus on shifting from traditional accounting to accountability with an emphasis on setting targets for 2030 and tracking performances using CAGR, compound annual growth rate, and CDRR, compound annual reduction rate. Number five, the concept of return on intangible is introduced, described as measuring human capability and energy with the goal of creating more equitable and stable corporate management structure. In the next 4 pages, two for M&M and two for Reliance, I am providing you with the details of profitability and growth index. Entity rating is the combination of these two. Add one with the other to arrive at the third. The entity rating is very important. We have profitability index for M&M 331 and Reliance 311. Growth index is M&M 222, Reliance RIL 321. Entity index M&M is 221. And 331 and 221, 222 are added, divide by 2, take only the integer, you get 221. Reliance RIL is 311. Number of employees M&M is 260k and RIL is 350k. Zero means insentient, that is if it is not there. When we look into M&M finance costs, 540, other expenses 450, profits 550. These zero I have brought in of only in 2024, which is 0. Whereas in consumption, M&M has got 002. It started with 0 but ended with 2. Is quite outstanding because it's very tough reducing the consumption at 3%, which had been indicated as a standard. To get it to 2 is quite outstanding. So M&M had done a great job on that. RIL employee benefits 400. The employee benefits I find in most of the companies 0. That is actually is negative. That is, the input is the employee cost. The output must be related to the net sales. The net sales must go beyond 6 times, 7 times of what the employee cost is all about. Otherwise, the return on intangible or the effort being put by individual is not being presented. It's very important. The finance cost in the Reliance is 500. Inventory is also 500. Net fixed assets 530. Trade payables at 350. 0 means insentient, that efforts are non-existent. Accounting ex post facto strategy plan 2030. First, fixed standards for balance sheet, setting targets for 2030, CAGR and CARR, reduction rate. Second, track performance by CDGR and CDRR. It's like playing an ODI. If 260K or 350K people are there, form 5-member team. That's dividing by 5, 52K teams and 70K teams. Distribute to each and every process block. There are 308 of them. It can go up. One member in each team attends to ethical responsibility. Be very clear about it. Each and every member is also ethical responsible person, but one member is being solely responsible for ethical responsibility. Entrust the ethical responsibility blocks of 296 process blocks to women. One member women can have dual responsibility. One member woman can have dual responsibility, fiscal as well as ethical responsibility work. They can undertake dual responsibility. Track performance of each task by the 5-member team were yoked together but perform independently. Of the 52K or 70K respectively, as the case may be, who performs below the optimum level, identify and bring them up to the higher level with other team members. Make aware of the ratings for each team within first internally, and as and when the company is ready, announce it to the public. Entity, profitability and growth index. Proof of corporate governance is in the earnings. Shifting focus from accounting to accountability is the main importance. Ex post facto to ex ante. Remove the uncertainty, then only goals can be reached, which is the goal congruence for all the employees and stakeholders also. Optimum output by all. That is 555 continuously in every process block. People have immense capability. Return on intangible means the capability of being measured. Intangible is defined like 0 being found as a number. Intangible is proved as a constant. Energy force. That's why we are analyzing the matter energy. Rest is matter. There is only one energy for human energy, with a fixed value in a specified mathematical context, enabling the accomplishment of infinite succession of finite purposes by controlling each goal. Return on intangible inverts the corporate structure to create an equitable new stable element for corporate management, like that of the well-established mathematical and natural sciences. Accounting is not science. It's not science-based, but a debit-credit hypothesis. It has tied the management down to ex post facto analytics. Accountability can never happen. Aim for accountability and unleash the energy of other people for companies to make targets and reach out to Viksit Bharat 2047. We are now at the action process rating system, when we are going to look deeply into what the companies have done in the last 4 years. Action process is crucial for organizational goal congruence, focusing on increasing revenue, containing costs, and managing investments. I advocate for publishing future strategic plan 2030 in annual reports rather than just reporting past performance. Number 3, banks and companies should set long-term growth targets and work backwards to establish a daily growth rates for reaching 2030 targets as on today by CDGR, that is the daily growth rate, and CDRR, daily reduction rate. I talked about the concept of over 7 factor based on physics principles, a critical conversion factor of .over 7 for optimal performance in business processes. This is why we have created the SOS governance standards for critical density. Finally, here we look into earnings of Mahindra and Mahindra, and as well as Reliance I have brought in, of the last 4 years, how they have done and where they have to set their eyes for strategy plan 2030. Possibly we can find out who can reach the targets of Viksit Bharat 2047